For the first time since December of 2024, the United States Central Bank decided to cut interest rates by 25 basis points. What does this mean for the markets? Now, the reason why this meeting was so important was because it was an official shift from inflation concerns to labor market concerns, where for the first time since the pandemic, the Federal Reserve used language to describe the labor market as softening instead of solid. Looking at this chart above here is what's known as the dot plot, which each one of these dots here represent a member of the FOMC and their vote on where they think the Fed funds rate should be. As you can see, from now until the year 2028, the average FOMC member thinks that the Fed funds rate should remain anywhere between 3% to 3.25%. And this is mainly due to the fact that they think that growth is going to slow significantly this year and next year, and then finally pick up in 2027, where inflation is going to remain sticky this year, but end up dropping pretty quickly. They've been wrong about this for the past couple of years, but maybe they'll be right this time. Now, this growth projection obviously flies in the face of the Atlanta Fed's GDP Nowcast, where they have this year landing at 3.3%, which is almost double their estimate. Now, this is all happening as inflation is set to reaccelerate, as we see the Cleveland Fed's Inflation Nowcast has for the month of September, inflation across the board rising to 3.0%. Now, what this implies and what the market is interpreting this as, in the medium term, the Fed is going to successfully achieve a soft landing where growth starts to rebound slowly as well as inflation starts to come down. What's interesting is the immediate market reaction in things like Bitcoin, which is having a rebound. Gold actually started to have a correction. Bond yields started to have a spike up. The dollar also had a little bit of a rebound. And the United States 5-year break-even inflation rate also had a large spike, suggesting that inflation is going to remain stickier than the Fed expects. Ultimately, this is very bullish for risk on assets, but if you want to eliminate uncertainty, we have our free newsletter called the Daily Index Ranges, where every single morning before the market opens, we send you the trend signal as well as the trading ranges for these indexes here so that you can stay ahead of the curve. If you want access to this, you can DM me the word daily and I'll send you a link so that you can sign up for free. Now, the key metrics to pay attention to from here to see if the Fed is going to continue their rate cutting cycle is to pay attention to inflation data as well as labor market data. If we start to see inflation continue to accelerate after the month of September and into November and December, then the Fed could slow down their pace of cuts. But if inflation remains, somewhere between 3.0% and 2.8%, and then the labor market continues to go down, then you could get more aggressive cuts. But what do you think? Let me know in the comments below, share this with a friend, and I will catch you in the next video.